can you just decode what we're seeing in the 10-year yield under continued pressure? And it comes at an interesting time. We're seeing the markets pretty much continuing to stay hot and rally back off those lows of the year.
Well, I think when you look at the nominal yield in the 10-year, it's just sort of been edging a little bit lower over the last several weeks after the big drop that we had. It's mostly sideways, but the real yield, adjusted for inflation expectations, has been dropping into negative territory. So when I look at it, what it tells me is the market expects the Fed to stay on hold for several years, which is what we've been told. It expects growth and inflation to remain low, and that's reflected in the nominal yield and the real yield dropping. But what is concerning people is longer term inflation may pick up. So we're actually saying, say, TIPS, Treasury Inflation Protected Securities, rally. So it's kind of a mixed picture from the Treasury market. On the one hand, Fed stays on hold, not much going on in the economy for a couple of years, but longer term concerns about inflation kind of bubbling up.
Kathy, good to see you here. What do you make of the news out this morning that the Federal Reserve said it's going to extend the operation of 7 emergency lending programs that it was set to have expire at the end of September? It's going to expand that now through December 31st. What does that tell you?
Well, it tells me that there's recognition that the economy is going to take a lot longer to bounce back than what originally had been thought when these facilities were put into place. You know, these were meant to be a bridge over the time from when the pandemic hit and we went into the lockdowns to when we opened up and the economy was up and running again. And obviously that bridge, it was thought it was going to be maybe a quarter or two. Now that bridge is getting a lot longer because we've had so many setbacks with the reopening. So I think it's a recognition on the part of the Fed that this isn't over yet in terms of the economy. And one other thing is there's a lot of firepower left in these facilities. They have not been used to their max by any means. So plenty of ammunition left for the Fed to use.
Kathy, are you seeing any red flags starting to emerge in the corporate bond market? Listen, we have a lot of earnings we've had a lot of earnings out the past 2 weeks, and one theme that has emerged from C-suites is that the activity or the rebound in business has slowed in July, and that recovery appears to have stalled.
Yeah, we're seeing a stalling out, definitely, in terms of economic activity. I think we'll see that in some of the numbers later this week that we get in next week. And that concerns us because we have a lot of highly levered balance sheets in the corporate bond sector, particularly in the high yield area, where defaults are already rising. Defaults are already up to over 7%. So the lower rated bonds of corporations that have just a tremendous amount of leverage and are not getting traction in terms of underlying revenue growth and profit growth, we're concerned that we're going to see those defaults pick up.
What do you make of the junk bond market right now? There seems to be a lot of appetite there. Are you concerned?
Yeah, I think that, we have this feeling that there's a Fed put out there for the corporate bond market. And there certainly is a lot of support for the market from the Fed's various facilities and their buying of ETFs, et cetera. But they have tried to draw the line between the fallen angels in the junk market, that is the companies that were downgraded from investment grade to high yield after the pandemic hit, and the rest of the market. So they're not committing to supporting the rest of the market. So my concern is it's sort of, everything is rallying. All boats have been lifted, and we're going to have to sift through now, those that are going to make it and those that aren't going to make it.
Kathy, another trend that has emerged is this earnings season. China, in so many cases, China, the economy is starting to come back, at least looking through the prism of big companies. Is one way to play that emerging market bonds?
Well, I think there's a couple of factors that should be supportive to emerging market bonds. I think you have to be pretty careful, though, because there's a wide divergence between, say, Turkey and, say, China or some other countries that are listed as emerging markets like South Korea that are really developed markets. But in general, a weaker dollar, low real interest rates, a very supportive fiscal and monetary environment should be good for emerging market bonds. They got beaten up badly, particularly the currencies late last year and early this year. They've bounced back quite a bit. We think that for people who have the risk appetite and can handle the volatility, emerging market bonds might be a place to find some added income in this market.
I want to get back to some of those high yield bond scenarios for a moment, Kathy, because we're seeing companies sort of at the lowest end of the credit spectrum flocking to the market with debt offerings. They're being welcomed with open arms. We know the Fed has sort of said it would backstop the corporate debt market. It's sort of bought up a little bit. But what would you tell investors who are looking at that very speculative space right now and trying to make some decisions?
Yeah, I think this is where you really need to do your homework or find somebody who will do it for you if you're not a credit analyst. But we're generally advising staying away from the lowest rated bonds. And if you're going to be in high yield, you really need to keep it at a limited allocation, because as those defaults start to pick up, the recovery rate, so say you own a bond of a company that's defaulting, the next step is, well, how much do you get back when they've defaulted on that bond? In this cycle, because the covenants and the promises that corporations made were weakened because there was so much demand, your recovery rate's going to be low as well. So this is where you really have to do your homework and figure out, which companies are going to be able to make it, which ones are not, and what's my risk reward in this kind of a market.
Kathy, before we let you go, the Fed meeting, if it is in fact a status quo conference press event from Chair Jerome Powell and a status quo press release, what happens to the bond market?
Probably not too much. I mean, that's what's anticipated by the market. Obviously, the press conference is going to be what people really focus on, because we're not expecting a policy change. It'll be interesting to see if they embrace the idea of inflation targeting or an average inflation rate, or overshooting their 2% target. That's going to be the most interesting, and that could be a big driver of those inflation index bonds, because people would probably react by saying, oh, we're going to see an overshoot on inflation eventually.